Of the tape and whether today's jobs report was just right to keep the Fed from turning much more aggressive, even as it shows still strong labor market, and what it all might mean for the rally. Let's ask Charles Schwab's Liz Ann Sonders, chief investment strategist there. Liz Ann, great to speak with you on all this. I mean, I guess the question is, do you think the market is correct to take a little bit of comfort out of today's numbers? Essentially, we're not seeing an overheating economy, but also not one that's outright stalling.
Yeah, I suppose in the context of the nearly 500,000 ADP print, which really kind of freaked out investors, I think it could take some comfort. But of course, we're starting to see the weakening that although the Fed wants to continue to quell inflation, might be starting to send some signs of sort of full official recession versus what we've been calling the rolling recession. I think it was the slightly hotter than expected wage number and the uptick in hours worked that probably moved the needle a little bit in terms of probabilities for a July hike, which were already high, but now they're up around 95%. Beyond that, meaning September, it's the data that's going to define what the Fed does beyond July. But I think a hike is basically baked in.
Yeah, it does seem that way, certainly at this point. Although, what are you picking up in these numbers today that suggests to you that we may be now getting closer to that more broad-based formal recession? I mean, obviously, there were downward revisions to prior months' job gains and then about a 40,000 job miss for June.
So you also saw the spread between household and payroll or establishment survey data. The establishment survey is what generates payrolls, and then the household survey is what generates the unemployment rate. And although that in the case of household was up, that is compared to a pretty big negative the prior month. And out of the last 15 months, 5 months have seen big declines in household employment, and that tends to lead as you're heading into a downturn in the economy. We've also seen the rolling over in temporary jobs. That also tends to be a leading indicator. And although we had a little bit of relief in terms of unemployment claims, the 4-week average is up more than 30% from the trough. And the average heading into recessions of claims is up only about 20% from the trough. So it's certainly not a done deal, but maybe a few more little check marks you can put in the recession column.
Yeah, it's interesting because, of course, I think there's been in the last couple of months this consensus migrating to the idea that we're pushing out the potential date of an onset of recession. It seems like things can appear and feel like a soft landing for a little bit longer. Meanwhile, though, yields have backed up to a point where, the 2-year yield almost back to where it was right before that SVB regional bank scare. And, of course, the 10-year flirting again with 4%. How does that filter into the, I guess, the way the equity markets might be able to handle this environment?
Well, and keep in mind, as you know, Mike, nominal yields are up, but so are real yields because you haven't seen a commensurate increase in recent inflation data. So you've got that pop up in real yields. And given that the rally off the October low was more than all accounted for by multiple expansion, there was no earnings component to it. I think in conjunction with the move up in yields, I think it just puts some downward pressure on some of the more highly valued segments of the market that were probably ripe for some profit taking anyway, because you had started to see not only overbought conditions, but that concentration problem. On a day like today, seeing a pretty significant rally by small caps via the Russell 2000, we've had smatterings of those, and I think it's good to maybe see convergence happen by both a little bit of profit taking up the cap spectrum into those names that were solely driving performance, but also greater participation by the so-called average stock. We need more of it, but some comfort in that today, given that broadening out.
Yeah, certainly the market has had, coming into the second half, plenty to prove on that score. I know you feel that investor sentiment has also gotten to a point where it's becoming more challenging, maybe more of a headwind from here. What are you looking at specifically that says that maybe raises the bar for further gains?
Well, if you look at behavioral measures like fund flows, and we focus a little bit more on ETFs because there's more activity there relative to traditional mutual funds, about 80% of the flows in the past month or so have been on the equity side of things. You look at a variety of the so-called, smart money, dumb money confidence measures. If you look at some of the attitudinal measures like AAII, although a little bit off the boil, in general, you're in what might be deemed excessive optimism, or at least ample complacency that, and this is important, all else equal, is a contrarian indicator. Sentiment can get frothy and stay there for years, like was the case in the late 90s. So don't ever consider a frothy sentiment environment as some immediate, sell signal for the market. But all else equal, I think it represents at least some near-term risk to the extent that there's a negative catalyst.